In other words, it's like straightforward, most common, most people use it. So these plain vanilla bonds are like coupon paying bonds. So what do I mean by that? What do I mean by that? That means this bonds bears a coupon payment, okay? And this coupon payment is periodical. You can consider this coupon payment as the interest payment, okay? And throughout the life of this level coupon bond, the level of the coupon will not change. Okay, so basically, when you're looking at a bond, a level coupon bond, you're gonna collect coupons periodically. That's number one. And number two is that you're gonna claim a lump sum, a large amount of payment that equals to the principal of the bond at the end of the life of the bond. Okay, so for example, if there is a 8% semi-annual level coupon bond that matures in 30 years, it's going to give you coupon payments every 6 months because it's a semi-annual bond and for 30 years. So so you're going to have a 60 payments in total, and each payment will be half of 8% of the principal value. So let's say if the principal value is $1,000 and you borrow 8%, that means your coupon will be $80 per year. And because that payment is going to be made semi-annually, so that means every 6 months you get half of that. That's $40. Okay, so that's the coupon payment. And then there's a lump sum, a face value payment. That's $1,000 in the end. Okay, that is 30 years from right now, in the last period. So usually the principal value, or it has another name called face value or par value, is $100 or $1,000. Okay, so when you are quoting a bond in the exchange or in a brokered market, what you usually get is not a price of the bond. Usually you're going to be given a return of the bond. Okay, so or the broker is going to tell you how much higher or lower your bond is traded at your par. So if your bond is traded at 110% of the par, that means your bond is traded 10% higher than par. Okay, so even though we don't touch on those in this class, but in your future finance classes, you're going to see those. So here, I try to be more explicit, more formal about how we calculate the coupon. So the coupon payments every year is calculated as the coupon rate multiplied with the face value. In our example, if we have $1,000 principal or face value, 8%, that equivalents to $80 per year. And because it's a semi-annual coupon bond, so coupons are going to be paid twice a year, so $40 each time. So $40 every 6 months. So relative to coupon bond, there are zero bonds or zeros. So usually zeros are only issued by the Treasury, that is the Fed. So a zero bond has no interim payments, okay? And that means when you are buying the bond, you pay some money, and when the bond matures, let's say a year later, you collect the principal. That may be $1,000 or $100. So how do you earn any profit on such a zero bond? So the answer is that you pay less than $1,000, right? So it's just like investing money, anything. You pay less than something you're going to receive, right? So in this case, it's just it's known that you're going to be paid a certain amount of money in the future. That is the principal value. The problem is, or the question to you is, how much you're willing to give up for that $1,000 in the future. All right. So how do we evaluate a bond? So when we are evaluating a bond, what we are doing is we know that by holding the bond, you're going to be able to get a sequence of cash flows. And this cash flows is pretty much fixed, right? You know that if you're buying a bond, you're going to get some coupons and you're going to get a principal. And once you decide on the discount rate, you should be able to calculate, or once you can decide on the return you want to use to discount the cash flows, then you should be able to get the present values of all these cash flows, right? So we said that when you are calculating the present value of cash flows, the present value you got, assuming the rate is the rate you can invest at, right? You basically can recreate the cash flows that this coupon bond gives you, right? So for example, if it's an 8% semi-annual level coupon bond, matures in 30 years, you're going to get $40 cash flows 60 times every 6 months. And then you're going to get a par value, that's $1,000 at the end of the period. And if you assume you can invest at 7%, the present value at 7% should be able to give you the same cash flows as the bond if you invest that money yourself at 7%, right? So that's what we're going to do. We're going to try to calculate the present value of such a bond. What if, and then we say, okay, what about the present value is 8%, or sorry, what about the discount rate is 8% or 9%? So the calculation is pretty straightforward. We can use Excel, or we can use a financial calculator. So I'm gonna illustrate in Excel. So this is Excel. I'm gonna open a blank workbook. So in Excel, you can calculate the present value of a bond using multiple formulas. Okay, so the first one we can do is we can use the formula called PV. So if you look at the PV formula, it asks for a rate, MPER, which is the number of periods, PMT, which is payment, FV, which is future value, and type, which is basically about whether you wanna have a beginning period convention or end of period convention. That is, do you assume you're going to receive the first cash flow right now, or do you want to assume that you're going to receive your first cash flow one period from today, right? Okay, so that's the function. So let's, instead of just using the function, let's spell it out. What I'm going to do is I'm going to say it's value of bond. And this one I'm going to say this is PV of rate, number of periods, payment, future value, and type. Here, B6. Okay, so once again, rate, MPER, number of periods, payment, future value, and type. Okay, so we're going to try to fill in these one by one. So we already know that our discount rate is going to be 7%, right? Our discount rate is going to be 7%. But because this is a semi-annual coupon bond, so in this, when we are using a PV function, we want to put a periodical rate rather than annual rate or annual quoted rate. So what I'm going to do is I'm going to say it's going to be 7 over 2. Okay, so it's going to be 3.5%. Okay, 3.5%. So this is the per period rate. And the MPER is the number of periods rather than the number of years. There are 30 years, payments every 6 months. So it's going to be 60 periods. So I'm just going to say it's equals to 30 times 2. Okay, it's 60 periods. And each payment is, of course, $40. We already know that. But it depends on the 8% coupon divided, multiply with 1,000 principal value divided by 2. That's per period coupon payment, $40. As you can see, we already got some numbers, but that number is not going to be correct because we haven't entered our future value yet, right? Because the future value is the lump sum payment which you're going to calculate present value with at the end of the period. So we already know that it's going to be $1,000. Okay, and type, by default, type is going to be all right, yeah, by default, time is going to be type is going to be 0, which is end of period convention. So we don't really have to do anything, but for me to be explicit about it, I'm going to put 0 in here. So there's nothing. If it's beginning of period convention, I put 1 here. You should see the number gets bigger, right? Number gets bigger, but this is just the beginning of period convention. There's no end of period convention here. So the function works, right? So it is 11, 24, 72, right? So what if the rate is going to be 8% or 9%? So what can we do is that I'm just going to copy this, paste it here, and paste it here. So if the rate is 8%, I can predict that this number is going to give us $1,000. As you can see, the value of the bond is $1,000. If the rate is 9%, it's lower than $1,000. Okay. So when the discount rate is the same as the coupon rate, what you get is something called a par bond, where the value of the bond is the same as the principal of the bond. Okay, so that's basically saying all of the return you're going to get, it's going to be from your coupons, because your coupon is the same as the required return. But if you have a required return that's bigger than your coupon rate, that basically means the return you can get from the coupons are not enough to cover the required return you want, which is, in this case, if you require 9%, you cannot really get it from coupon because coupon only gives you 8. So what can you do? You have to lower the price you're willing to pay so that the additional gain from the difference between the principal value and the amount of money you're going to pay for the bond is positive, right? So you have some extra profit there, okay? And also, if the discount rate is lower than the coupon, which is 3.5% in this case, a coupon semi-annually is 4%, right? So the annual discount rate is 7%. So your coupon is giving you 8%, so that's better. So that basically means you're going to lose some money by paying more than the principal. Okay, so that's the calculation of the valuation of the bond. Okay, so then we want to talk about an idea called yield to maturity. So the question is basically saying it's basically the other side of valuation, right? So in previous discussions, we talked about, okay, so when you're trying to make decisions about a project, you can use the NPV rule, but in which you are calculating the valuation of the cash flows, and you're going to compare it with the initial cost of the project, right? And you can also compare the return between what you're going to get and what you require for investing in the project at a different price than what the value of the project is. So here it's the same idea. Instead of calculating the value of the bond, you can actually calculate the promised return of a bond when you buy the bond at a certain price. So for example, if you have a 15-year 8% semi-annual level coupon bond with $1,000 par value that costs $896.81, what is your return? What is your return? So it's going to be the discount rate that's going to drive the present value of all the cash flows of this bond to $896.81, right? Because, when you have $896.81, with that return, you must be able to replicate the cash flow of this 15-year 8% semi-annual level coupon bond. So let's again use Excel. So the instead of calculating the value of the bond, now I will be calculating the return of bonds. Okay, So make it a little wider. So the return, to calculate the return of the bond, we are essentially trying to look for this, right? We're essentially trying to look for this. So we will need to use a formula that's called rate. So rate has these arguments: number of periods, payment, present value, future value, type, and gas. So I'm gonna go over these one by one. But before that, I'm just gonna select the argument. PV, future value, type is gonna be 0, but anyways, and gas. Okay, so as you can see, it gives an error, but don't worry about it. It's because we are entering all zeros for these. So what's the first argument again? MPER, right? MPER payment, PV, FV, and type and gas. So the type and gas, they're and future value, they're optional in this case, optional in this formula. But to evaluate a bond where you have a lump sum at the end of the period, you need the future value. But type is going to be 0. Gas is completely arbitrary. You can put 0, you can put whatever you want. So I'm gonna explain why people need gas. So the number of periods, because there are 15 years and it's semi-annual coupon, so it's gonna be 30 periods. And the coupon rate is 8%, and the par value is 1,000. So the payment is gonna be the coupon payment. That equals to 8% times 1,000 divided by 2. That's $40. At the present value, what's the present value? The present value is the value you're gonna pay the bond at, 896 and 81. 896 and 81. Okay, and the future value is 1,000, right? It's the lump sum payment at the end of the period. Well, as you can see, I still have an error. So this error is called numerical error. So that's basically saying after Excel going through all the numerical solutions, it couldn't find a solution. Okay, so there are some problems with our numerical specification. So what's wrong with it? This should be negative, right? So if you have been to the other sessions where we talked about how to use Excel to calculate the rate given a kind of cash flow, we need to, when we're doing that, we will have to specify the directions of cash flows using positive and negative signs, right? So in this scenario, present value and payment, they are of different directions, right? If you buy the bond, you will have to pay this present value and you're going to collect the payment and future value, right? So we have to have a negative sign in front of it. As you can see, it is 5%. So I'm going to make it a little finer. So because this 5% is 4.64%, it is a periodical rate, right? This is a half-year rate. So what I'm going to do is I'm going to multiply this whole thing. I'm going to multiply this whole thing by 2 so that I don't get a half-year rate and I get a annual rate, 9.92%, 9.29%. Okay. So next thing I'm going to do is I'm going to copy and paste and look at the $1,000 and 1124.72. Okay. So the future, the present value is negative 1,000. So again, I can predict this number is the return on the bond is going to be 8%, right? Because this is a par bond. In a par bond, the present value is the same as the future value, which means the price of the bond is the same as the principal of the bond. The last one is 1124.72. So, oops. Negative 1124.72. So I got 6.67%. Okay, so these are the return on the bond. So these returns are called yield to maturities. Okay, so in the book it's called yield of maturity, but some books or some people will call it yield to maturity, YTM. So it's basically saying it's basically the return you're going to get if you buy the bond at this price, and you're going to hold it until maturity. You're not going to sell it in the middle. Okay, so that's the how to calculate yield to maturity using Excel, and that's the concept of yield to maturity. Okay, so and also when you're looking at the Wall Street Journal, you're going to find bond quotes, and when you look at the bond quotes, it's going to be quoted in yield to maturities. Okay, YTM. Okay, and of course, yield to maturity translates to the value of the bond, right? So when the bond is traded at 896.81, the yield to maturity must be 9.29%. Okay. All right. So once again, yield to maturity is a promised rate of return under some conditions. Okay. It is a annual quoted rate. That's not an effective rate that the investor is going to earn if all of the following three conditions are met. The first one says the investor purchased the bond at this price. Okay, so this is not guaranteed because you're going to face some liquidity issues in the bond market, and you're going to have some microstructure problems in the bond market. But we're not going to talk about that. But what I want to say is, even if you observe that some bond is being traded at a certain price, you do not guarantee to be able to get in that price. So the second thing is investor holds the bond till maturity and receives all the payments. This is not necessarily going to be the case, especially when you're investing in the corporate bonds. In the corporate bonds, sometimes the corporate will actually call the bond. That means they're going to pay the bond early, and in the end, you're not going to be able to get all the you're not going to be able to get all the coupon payments. You may get a principal that's a little higher, but it's not necessarily going to be as good. In that case, we have a term called yield to call. So, but we're not going to talk about that until your 300 level finance course. And the last one says investor should be able to reinvest the coupon at the yield to maturity. So when we were calculating any such implied returns using the cash flows, we are always making this assumption. That is, we can reinvest at the calculated return, which is very difficult. Okay, which is very difficult. If you're invest in a low interest environment, and you're promised a, let's say, 5% yield to maturity, it's really tough for you to consistently invest in a very low risk scenario at 5%. Okay, but if you take high risk in stock market, yeah, probably you can. But if you're trying to pick the same bond, you likely won't be able to. Okay. All right. So about the reinvestment assumption, I just want to talk a little bit more. So when you are calculating present values, we are always making some reinvestment assumptions. Okay, when we are discounting cash flows, we are assuming that we can reinvest at the discount rate. If when we are calculating the rate, the return with given cash flows, we're assuming that we can reinvest at the discount rate, because that discount at the calculated rate, because that calculated rate is essentially a discount rate, right? If we flip the coin. So let's use this example to briefly illustrate how what I mean by the reinvestment assumption, and if the reinvestment assumption is violated, what's going to happen. Okay, so let's say we have 3-year $7 annuity with 10% discount. So let's still use Excel. We can build a little model where things are going to get easier. So I'm going to create another sheet and zoom in. So I have a year, 1, 2, 3, and I have cash flows. It's going to be 7, 7, and 7, right? We have this kind of cash flows, and we have a return of 10%. 10% discount rate. Okay. Okay, 10% discount rate. So what's the total present value? Okay, what's the total present value, and what's the present value of each cash flow? Okay, what's the present value of the whole thing? What's the present value of each cash flow? So the present value of the first cash flow is very simple. That is equals to the PV, right? PV function. The rate is 10%. The number of periods is just one period later. And we're just calculating this one cash flow, right? So it's not a payment. It's not a repeating cash flow. It is repeating if you look at the 3 years as a whole thing. But when you're looking at this first $7, just one payment. So it is not a periodical or repeating payment. So we're going to put 0 for payment, and we're going to put negative future value. Okay, so that I got a positive number. And then what I can do is I can just copy and paste and paste. So if you look at the second one, you're going to see that we're using 10% as return, 2 as the number of periods, 0 as the payment. If we use 7 as the payment, the calculator will believe that we are using, the calculator will think that, okay, we have $7 at the end of year 1 and then another $7 at the end of year 2. We don't want that. We just want to calculate the second $7 at the end of year 2, the present value of the second dollar at the end of year 2. So we don't want to actually specify payment at 7, but instead we specify future value at 7. Okay, and the last one is the same case. If you look at the last one, it's number 3, right? So the number of periods is 3. It's like 3 years later, we have a lump sum $7. So the present value is very simple. You can just add up the 3. Okay, equals to the present value. Oh, sorry. Equals to the sum. You can just add up the 3, which is the same as when you specify PV. Rate is 10%. Number of periods is 3. Payment, there are 3 $7 payments across the 3 years, right? This time it's going to be a repeating payment. As you can see, I got the same number, right? Okay, so we're good. So we got 17.41, right? So we say that in this case, we're assuming that we can reinvest. Okay, we can reinvest. Okay, what if we cannot reinvest? Okay, what if we cannot reinvest? Or what if we assume a different reinvestment rate, right? What if we assume a different reinvestment rate? So let's have a structure of calculation, and then let's build in a reinvestment rate assumption, right? So the first one is discount rate. We know it's 10%. Reinvestment rate. Previously it was 10%. Let's keep it at 10%. Okay. And then we also have the cash flows. Of course, we also have the years, 1, 2, 3. And then we also have the cash flows. That's 7, 7, 7, and 7, right? So now I want you to think about what's going to happen when you actually invest in this thing. Okay, at the end of year 1, you get $7, right? What are you going to do with it? What are you going to do with it? You're going to, I don't know, put it in your pocket. Maybe you spend it, right? So let's just say you put it in a reinvestment account, right? Where you get 10%, right? Where you get 10%. So, so 3 years later, right? 3 years later, what do you get? At the end of year 3, how much money are you left with, right? So let's say future value of the first cash flow, and I have future value of the second cash flow and future value of the third cash flow. Okay, so the future value of the first cash flow at the end of year 3 should equal to the future value, or I should use the more traditional formula. It should be equal to the value of the first cash flow times 1 plus the reinvestment return, right? Raised to the power of 2, 3 minus 1, right? From the end of year 3 to the end of year 2, from the end of year 1 to the end of year 3 is only 2 years, right? So this should be the future value. That's about $8 something. And the future value of the second cash flow it's going to be very similar. It's going to be the second cash flow times 1 plus the reinvestment rate raised to the power of 3 minus 2, right? So this is the second one. And the third one is just 7, right? You should know that. And what I want to do is I still want to be explicit. The cash flow times 1 plus the reinvestment return raised to the power of 3 minus 3, right? Minus itself, right? So it's going to be 7. So total, oopsies, total future value, it's going to be the sum of the 3 future values. I got 2317, right? Then that basically means if you don't do anything, right? If you don't do anything with the money you got, but you just reinvest it at the discount rate, which is 10%, at the end of the investment horizon, which is 3 years later, you're gonna get $23, right? 2317. So what about the present value? Equals to the present value of the discount rate, right? We need the discount rate now. 3 years, there's no payment, and this is just this lump sum cash flow, 2317. So I can guarantee you that this number is 1741. Okay, right? 1741. So this is what I mean by the implicit reinvestment return. So we were following a very different process, but we got the same conclusion, right? Previously, when we were doing this calculation, we were assuming we were not even talking about reinvestment. But in this calculation, we are explicit about reinvestment, and we reach the same conclusion. So that basically it's saying that there is such a reinvestment assumption. So what if I tune up or down this reinvestment return? What if I assume the reinvestment rate is 5% or 13%? What's going to happen? If the reinvestment return is only 5%, as you can see, the present value is going to be lower than 1741. If it's 13%, the reinvestment return is going to be higher than 1741. So the assumed reinvestment return really matters when you shouldn't be worried about whether you assume a reinvestment return. You should be worried about whether the assumed reinvestment return is realistic, because you should always assume a reinvestment return, right? When you got $7, what are you going to do? You're going to probably reinvest it rather than spend it, right? So that's the reinvestment assumption. That's it for this video, okay? So if you have any questions, let me know.